Welcome to the Defenders of Business Value, the podcast that helps business owners unlock the value they've built and exit on their terms. I'm your host, Ed Meisegland, and for the last 30 years, I've been helping business owners prepare, grow, protect, and ultimately sell their businesses. Whether you're a business owner, a buyer, or an advisor guiding others through the process, if you want to make your last deal your best one, you are in the right place. So let's get started. Most business owners think of valuation as math, right? It's just about numbers and how you interpret the numbers. And from there, you get a value. And while there's a certain component that is true, that it is about math, for my guest, Charlie Stanton, it's really a story problem. He has a depth of knowledge of valuation. And as an appraiser, I really dig that kind of thing. So Charlie's, like I said, he's done hundreds of valuations across the country, from manufacturing to medical practices. And what sets him apart in the book, The Art of Valuation, he wrote the chapter about how business appraisal is a story. And to me, I resonated with that because the story and the narrative from the deal world is really important. That how the financials tie to the narrative that the seller and buyer are communicating, right? Be it through us or with themselves. We're telling a story. That was the big thing of why I wanted Charlie on. So we're diving in how a compelling business story builds trust and ultimately value, and how the bigger the mess of your business, likely it's going to scare off buyers. So we'll unpack kind of the pitfalls that trip up sellers as well as buyers, and talk about what kind of appraisal or appraiser you need. So I love this conversation with Charlie, but he's an easy guy to resonate with. So if you want to shape your story and your number that buyers believe in, this is an episode for you. So Charlie, welcome to the show.
Hey, Ed, thanks for having me here.
It's good to see you. I've been hoping to get you on, and you know why? This book, my man. Look at that. So, and no, thank you. I appreciate the autographed copy, and that's what I want to start with. Is your section in here is about valuation story. To me, being able to communicate a complex thing like this is so important, especially in today's age where there's so much information, and to be able to create a comprehensive and coherent argument of why, whether it's buy side, sell side, regulatory side, or whose ever side, I think that is material. So let's talk about storytelling.
Perfect. Yeah, no, thank you. And I think it's so crucial to handle storytelling because we're storytelling animals. And I think that's really come into the general knowledge of people now, is that we love storytelling. So the idea that facts stand on their own and that tell their own story, it just doesn't work that way. And in valuation, in finance, that's crucial because people think, oh, the numbers speak for themselves. But there's a lot of ways numbers and information like that can be interpreted, and it can go the wrong way. So the book that I contributed to, the article I wrote, or the chapter I wrote for that, I pulled a lot of information from a book called Story Smart by a storyteller named Kendall Haven. He was always fascinated with the science behind storytelling, why certain stories work, why others don't, what makes up a story, what is a story. He's got a great book that it's pretty short, I don't know, maybe 120 pages or something. What they did is they attached all these people to fMRI machines and told them stories. And the first takeaway really is that people have what's called a neural story net. Those are all the neurons that are firing. So as you're telling a story, all this data is coming into you and your brain's trying to make it put into a coherent story. So the first one is our neural story net. Our brains have taken information and tried to consolidate it into a story. Then on top of that, we have something called a make sense mandate. And what our brains do is if something doesn't make sense, it makes up information, it pushes information away, it infers information, or infers relationships that don't exist. And so what our brains are really good at is if they're hearing something and there's categories that we need to hear, if we're not hearing them, we will do whatever we can to make it make sense to us. Now, that may not make sense in the real world. That may not make sense anywhere else, but it's going to make sense to that person. So conveying our stories to an audience is really important for that reason. And there are about 8 different aspects that we need to hear, 8 elements that they've discovered for a story. So the first one is the character. Every story has a character. In valuation, it's the business. The business is the story. And then the second one are traits. Every character has certain traits that exist. And so we do that in valuation. We're discussing what the business is and, how many employees do they have? Where are they located? What products do they sell? So we have to describe those traits. Then there's goals. Every business has a goal of what they want to achieve. Is it profit? Is there purpose behind it? Is it market share? Is it growing out? Is it a lifestyle business? And then what a story needs is a motive. And every business has some sort of motive. That's a lot of times the mission statement that businesses put together. It's why they're running that business. Again, is it lifestyle? Is it we think we have a better product than all of our competitors? Do we offer a better service? What really drives that? After that, there's conflicts and problems. And that is the conflicts and problems come up between where you stand today and the goal you want to achieve. So we need to discuss that when we're valuing a business. What are the conflicts and problems? Do we maybe not have the right staff? Do we maybe not have key staff that we need or a good sales team? A lot of small businesses, the owner does a lot of the generating marketing, negotiating contracts with customers. So there could be those conflicts and problems that stand in the way. Then there's risks and dangers. And we do talk about those in businesses, but it's also a really key aspect to storytelling. So every business, their risks are really described as the probability of something happening, and the dangers in storytelling are the magnitude of that. So in a good story, the risks and the dangers are really high. When you're valuing a business or you're running a business or when you want to go to sell it, you try to actually do the opposite of that. Bring the risks down, bring those dangers down. Maybe you do have high customer concentration. You're one phone call away from losing, potentially a huge amount of your revenue. So those risks and dangers exist. There's struggles, and that is where the valuation sort of comes together. So you look back at the character, the traits, the goals, the motives, the problems, the risks, and the dangers. And then the valuation, sort of that struggle. That's the main heart of the story, where we're going from where we are today to where we want to be. And how are we going to get there? So valuation practically, is that the income approach? Is that a market approach? Is that using multiple approaches and, reconciling the value? And then the 8th element is really just details that kind of fill in the gaps and everywhere else. But what they've learned from this research is that your brain is searching for about these 8 characteristics. And if you don't see those, then the make sense mandate of your brain is going to put in. So if you really don't want to talk about the risks and dangers of your business, hey, this is the world's greatest business, there's no problems with it. If you're a seller, your buyer's going to say, no, there's risks. And then they're going to start inferring their own risks, which then could really detract from the value that you're trying to put forward. So it's almost a way of saying, let's be forward about a lot of these issues. Let's own the narrative so that our buyer isn't trying to create their own narrative, or, when they come back in negotiations and say, oh, your large competitor just moved in and now they're going to wipe out the business that we're potentially buying. So
Interesting.
these key elements are important, and your brain's going to look for them whether you want to or not.
The funny thing is that we're knee deep in the middle of, the dawn of AI, right? And so you hear these terminology, it hallucinates. It's the same thing. AI is filling in the gaps based on absence of information.
I'm actually stealing that because that's exactly what it is. If it's not there, it still needs the information. Your brain's not okay with just saying, oh, okay, well, Ed never brought up any problems with the business, so I'm fine with that. Let's move on. And say, no, that's a part of a story that my brain's hardwired to look for.
What's so funny is I'm sitting there going, all right, so here's these 8 things. The part of me wants to quantify each of those 8. Either my risk is going up or my risk is going down as my narrative is going along. There's not really a question in there, but I struggle with the narrative, right? You control the narrative, so you're controlling the information. Does it affect value by when you control it, right? Or are you preserving it? Because it's one thing to write a report or to communicate it in a courtroom or in front of a regulatory body. It's another thing when you're in a negotiation. You know what I mean? What's your thought on that? I know there was a lot of words with not a lot of question.
No, and I think that's the magic of it. I think any sort of professional, why we exist, is we're trying to navigate that process. That's the hard part. And that's why I first like this process of just nailing down what are those elements, because I'm like, those make a lot of sense for me. For me, in terms of an IRS report, I can put all of these out in terms of an analysis. And depending on the approach I'm using, those will be quantified in terms of, well, maybe I'm not going to use a higher multiple because 80% of the revenue comes from one customer. So there's professional judgment that creeps into there, but this will help from a valuation standpoint. This will help me sort of discuss that narrative and why I'm doing something. I'm not going to say, yeah, we're going to give you the average industry multiple when you've got all these risks. And not only you have a lot of risks, there's a high probability they're going to happen, and the magnitude of them happening when they do hit are huge or catastrophic. So we got to factor that in. Or it's the other way. Maybe they're not big. You look at companies like Apple, like they could get hit with a lot, but they can weather a lot of storms.
That's a critical mass thing. They may take it on the chin, but they're one new product away from rebounding,
Right.
Going back to the narrative, I totally believe in transparency. You might as well just share it all, because at some point, whether it's today or tomorrow or 30 days outside of close, somebody's going to find this out, right? So you might as well, the story should be complete. And so, and again, back to your comment, I'm curious to know, does that preserve it? Wouldn't it be great to have a study on the delta? Like if you say, look, as is sale kind of thing, you go figure it out. I suspect that the value would be lower than being transparent.
Yeah, I would think so too. Anybody who's dealing with risk, I think you always do the job. Here's the problem, and then here's what we think that solution is, right? Maybe you haven't implemented it yet, but I think especially in a transaction situation, is we have high customer concentration. That's why we're hiring a salesperson. Or even if we haven't done that yet, we're recommending that. And it might hit the cash flow and it might lower the value a little bit, but that's how that's impacting the business value today. And what I mean too by controlling the narrative is it's saying, hey, we're getting out here. Here's the issue that we're seeing, and we have tied it back to our valuation. We're not just going for the highest valuation and then we're going to negotiate down, because if you could say we had this issue, this is how we think we've impacted it in the value, either the cash flow, maybe if you use an income approach, a discount rate, if it's a multiple, maybe you reduce the multiple a little bit on some judgment, then that I think shows a buyer in that situation, hey, we consider. So no, you can't come back to me and say, now you want a lower valuation because you've uncovered this risk. Like, we've seen the risk, we've identified it, we've accounted for it.
I mean, one of the things I'm thinking about is, transparency risk. It's kind of like an unwritten risk, right? We've got all kinds of things across the board. I'm just curious to know whether or not, if that buyer looks at it and says, yeah, this guy's full of crap. So the transparency, while you can have all the bells and whistles, not only your narrative, but the financials, you could ultimately take a hit as a result of the mistrust in the narrative that you're sharing,
Yeah. Which gets back to the point which you probably suggest to your clients too, which I suggest is, if you're going to go sell your business, you should be getting a valuation or an analysis done at least, 5 years beforehand, just so you could start cleaning it. Because sometimes those things can take years to really fix, or they may not be fixable either, but at least you would know about them, aware of them, setting some expectations.
We've paid the tuition a few times where we've taken it to market and it doesn't survive due diligence, and we're back to the drawing board, and you're going to have to clean up your books. I know you didn't want to do it, and I know you needed to sell, but you either take a massive haircut to facilitate the risk embedded as a result of your crappy books, or go clean up your books and you can probably get another 2 turns on your multiple, Enough about storytelling. Let's talk about your practice. You do lots of buy-sell, litigation, regulatory work, right?
Yeah. So my main practice work is gift and estate work,
Right.
but also do divorce and M&A, succession planning,
Yeah.
some ESOPs occasionally in the past we've done. So yeah, it's all over the sort of spectrum of valuation.
Well, you know what? You are the second CFA on the podcast. And this was Colin King a couple weeks ago. And I'll say it to you too. No one has any idea what it takes to get that CFA. When you see that behind somebody's name, there's some horsepower that goes along with whatever they're doing for you. So
Thank you. Yeah.
talk about the valuations for the different purposes. When I am monkeying with value for sale purposes, right? It's Uniform Standards of Professional Appraisal Practice. I can follow that or I cannot. I just want to have the conversation of here's how this thing works. But in your case, talk about the different purposes and the standards that you have to adhere to for that purpose.
Great. Yeah. So for gift and estate tax work, you're writing that report not for the owner, not for their accountant. You're writing it for the IRS. And knowing your audience is crucial because they require different information. The IRS has a revenue ruling 5960 that outlines basically what they want to see in an appraisal report. And it's for anyone who wants to do valuation, I actually recommend reading revenue ruling 5960 because it's actually a really good roadmap of what you should consider when looking at a business. It's a pretty basic roadmap. And so on top of that, then there are certain standards like USPAP. That's what I follow. The AICPA has their own standards as well. And then NACVA, I think, has their own standards. They're all pretty close in terms of an industry, but there's nuances. And then our valuation report. So if it's going to the IRS, it has to have a background. We need to talk about the industry in depth. We need to talk about the economy in depth and tying those back to the value of the business. And then we want to pull as much data about the business as we can to support whatever value conclusion we have. But we always look at all three approaches in every valuation engagement. We look at the income, the market, and the cost approach. And then there's obviously methods within there, but the IRS wants to see all that. And then under gifted estate tax work, you could do discounts for lack of control, discounts for lack of marketability, which then can help reduce the value even more.
So there's standards that you have to follow along for each given purpose. But the real magic in the work that you do is what comes at the end, which is minority and marketability discounts. So before we go much further, we need to make it clear that if you have an IRS valuation, don't show up at an investment bank or a deal shop like ours and say, this is the value of my company. Can you talk about the difference between fair market value and market value? Then we're going to swing over back into control and marketability.
Perfect. Yeah, those are very crucial. I think a lot of people get frustrated because they say, oh, I had a business appraisal done and it's way lower or maybe way higher than what my business broker is telling me it's worth. And that happens a lot. So fair market value is the value. It's a legal definition too. It's a willing buyer, a willing seller, neither under compulsion to sell or buy. They know all the relevant facts of the case. They can go into the engagement together. That's a hypothetical standard. And so people need to recognize that it's not a marketplace standard. And so a lot of times it's not your main competitor moving in or the PE shop buying up in your industry and your location. They might be paying 50% over, sort of fair market value, let's say. So that's not necessarily fair market value. So we have to follow the fair market value standard for IRS engagements. And so it's a hypothetical buyer and seller. We're looking at effectively means we're looking at the universe of buyers. So it could be a management buyout, it could be the PE firm. We look at all of those. Whereas what I, in my reports, call them like investment value or strategic value is more of like what you're trying to do is a strategic sale a lot of times because you're trying to find the highest bidder or the best fit for your business. And in fair market value, we're just not doing that at times. And so I think people too, they just kind of miss the fact that one business can have multiple values just depending on who owns it, the purpose of it, and then the lens that we look through it in terms of fair market value versus strategic value.
And one of the things I always say is like, look, fair market value, and you're giving me your divorce valuation or pick whatever report you're giving me. This is assuming that there is an entire planet that wants to submit offers for your business. And I can tell you that is not the case. This report It's evaluating the merits as an investment. We're looking at it as an operating business, whereas this is it's an earning stream that has risk. What's the likelihood that earning stream is going to carry on for the foreseeable future? That's what this report is telling us. I'm telling you that I can't tell you whether this is a good report or a bad report until I go through a process with you. The process is the adjudicator of the value. Regardless of what Ed says, regardless of what Charlie says, that's the adjudicator.
So the IRS is the adjudicator in that, and divorce, it's the other party is the adjudicator, and the judge or the other attorney, they are. So you're definitely writing it towards that group. And you're right, in strategic value or market value, if you want to call it that, it's like, you're looking at the current environment, interest rates, depending on the life cycle of that industry. There's huge demand for that business where, maybe 5 years later that demand swells up or it goes away. And so all those things have to be factored into the valuation, and we still factor them in terms of fair market value. But yeah, the fair market value again is looking for the universe of buyers that you're just not going to see. You're right. Strategic say, look, every buyer here needs an SBA loan to buy this thing, or they're going to want one. Your now value is beholden to terms of SBA loans and risk minimization. So
that's such a great point that you make is, you look at who the capital provider is going to be, and that affects your value, right? Or potentially could. Let's swing back to where you make your real money, control and marketability. So talk about that, because I don't think that people understand the easy part of a business valuation is getting to the step right before here, right?
Yeah, I will say this is where you're going to be challenged a lot of the time. So the IRS allows for minority interests. And this is a strategy a lot of family businesses will use, is where they're gifting shares to children or to trusts or some sort of tax planning strategy. When minority interests are gifted, which is a lot of the work that I'll do, what we could do is say, if you're giving a 10% interest of $1 million business, most people say that's worth $100,000. Well, we know it's a minority interest. So let's say we read the operating agreement, you have no control. You can't transfer this interest to anybody. So there's now triggers what the IRS allows for discounts. We start with discount lack of control, which is saying, look, you own 10%, you can't do anything. So if you don't like the management, you don't like the dividend policy, you don't like whatever, you as a 10% holder can't do anything. So we can discount the value. Those range between usually 0 and 20%. We get that number by looking at recent premium. So it's a theory-based practice, which is why the IRS also likes to nail into it. It's basically saying if you're willing to pay a premium to own 100% of a business, in theory, you're willing to pay a discount to own a minority interest of a business. And there is some market proof of that from time to time, but it's also hard to get that, as businesses, when they transact, they don't really publish all this information publicly. So from some of the research topics, but we can discount the value there. Then after that, we do the minority interest or marketability interest. And that is looking at liquidity and the saleability of a business. So a 10% interest, sometimes the operating agreement's going to say, yeah, okay, you can't transfer it to anybody. We're the only people who can buy it back. If you want to sell, you got to come back to us, and we're going to make that, right of first offer or the right of first refusal. And so you have no liquidity in this 10% interest that you own. And you have other factors. We go through these things called the Mandelbaum factors. It's a court case, and we list through all of them, look at the finances, the restrictions, the liquidity. How long is it going to take you to sell a 10% interest if you can sell? There's not really a market for 10% interest of a business. So those can range from 0 to, I've seen some appraisers go to 40% as a discount. So what happens is you can take $100,000 interest and then start reducing it by 20%, then another 30 or 40%. And you can end up with a $70,000 10% interest as opposed to a pro rata $100,000 10% interest.
The weird thing with the discounts, especially marketability, because the assumption that fractional interest has to have, right? Just take your example at 10%, right? Who in their right mind is going to buy that, right? And so you continue to ratchet down the value in order to, this should induce somebody to do this, right? In order to buy it. But at the same time, the argument is all logic says this isn't going to ever happen. Now it's all based on assumptions, right? We glossed over the assumptions that the narrative and the valuation that you're working through has a set of assumptions that you're confined to. You have standards that you're confined to, and then you have a standard of value that you're confined to that again says that somebody, given principle of substitution, will buy that fractional interest when everything in your head is like, there's no freaking way. There's no way you're going to buy it. So
there's one guy, I knew him pretty well, but he took the stance that if you had, let's say, a 10% interest, he would argue there's an 80% discount for marketability on that interest. He's not appraising anymore, but he would get that aggressive on the appraisals to say they're not valuable because it's this minority interest. You can't sell, you can't do anything with it. No one's going to buy it.
But then you kick back on it from the standpoint of, hey, the standard and the assumption implies that we have enough of a sampling given the principle of substitution and the likelihood of this earnings stream that you've already discounted. You already beat the crap out of it. Did he get that through at 80% or no?
He said he did. I never worked with him directly to know, but I was actually just on a webinar about a week ago. And one of the, a gentleman who's written a bunch of the books and does all this stuff. He does not believe in the discounts for lack of control. He handles it in the cash flows of the business. So he says, if you're a minority owner and we value minority cash flows, then that's what you're going to get as a minority owner. So maybe the owner's taking double the salary they should. You don't have any sort of pushback on that. And then for discounts for lack of marketability, it's in the valuation community, it's a very big argument because some people are real aggressive with them. Other people say, look, this is a really bad process they believe that it goes through to kind of come up with them. So I think in any valuation, if you can handle anything through the cash flows, the better, because there's already argument that even if you're using an income-based valuation, your discount rate, you usually try to impact for size, which is already going to have an illiquidity premium in it. So if you're already arguing there's illiquidity there, and then you're double counting for illiquidity in your marketability adjustment. So you got to be careful how they handle those kind of things.
Yeah, interesting. Because, I didn't even think about the size premium having an embedded marketability discount or
illiquidity.
Illiquidity. Yeah.
Illiquidity. So there's research that's come out that says, well, they really think the theory is, some of these researchers think that that premium is really just an illiquidity premium.
That 10Z is really a liquidity premium.
There are arguments that is probably what that's, looking at bid-ask spreads, because it's all pulls from public information. So looking at bid-ask spreads and stuff that is saying, okay, well, it's probably that.
It's funny you say that because it's not that long that I was trying to use like biz by sell, ask to sale. This is actual sale. And if you read the insight report, I mean, it's less than 10%, which is stunning to me. I would have assumed it was much greater, but such is life. The last couple things I wanted to talk about is I think it's important for people to understand that there's a difference between someone like you and me, right? I'm a deal guy. While I have the formal training, you can't come to someone like me for the purposes of what they're coming to you for. Can you talk a little bit about that? When you just hear the name appraiser or a business appraiser, or pick whatever you want to call it, there's just the assumption that all appraisals are created equal. So can you talk a little bit about how the public should be aware of what you do versus what we do?
Yeah. One of the key differences is I provide appraisals for various reasons, right? Gift and estate tax. So I am the trier of fact, again, the IRS. So I'm trying to do everything possible so you're not getting in trouble with the IRS when you're submitting your gift tax return with my appraisal attached to it. I'm trying to give them everything they need. In a divorce case, I am trying to give everything that I believe objectively my client needs for their case or what's going on with that case. If it's a ESOP, or financial reporting purposes, we're solving what requirements with standards, everything that we need to follow for those valuations. And then we're not the deal guys trying to get the deal over the line. So I could say the business is worth $1 million. It's not my responsibility to try to find a buyer at $1 million valuation. And for most of my cases, we're not looking for a buyer. I'm looking to satisfy, again, the IRS or a divorce case or an ESOP and ESOP trustee. So we're trying to use reasonable judgment to come up with solutions to some of these things, especially, and I think one thing too is that when we value a business, we're not trying to come up with what its publicly traded market value is. Sometimes people think that like, oh, this is what we sell as publicly traded. No. We're trying to come up with a privately held value for a small business that it maybe has a very limited market. Compared to you're trying to say, here's a value that I think we can go to market and sell. And I think I kind of will explain it to people like your real estate agent and appraiser for a house sale, right? Your real estate agent is going to come to you and they're hopefully going to drive it to say, this is what we think your house is worth based off of using valuation sort of methods. But their job is to try to get the highest value for the house, try to find that right buyer for the client. And then the bank comes back to you and says, well, we need an appraisal to make sure that you're just not paying as a cover. And so we kind of work that way. I feel like a lot of times in transactions, and especially transaction work, say, I've worked on multiple transactions, and a lot of times it's kind of a fair value assessment. Say, hey, I just got offered $2 million for my business. Does that even make sense? Here's some analysis. We'll walk through, look at multiples, look at cash flow. Yeah, that seems like a good deal for you. Or no, it's way under market or whatever. So we'll kind of be that assessment for people. We try to be very objective per our standards. I don't get paid off the business value I come up with. We get paid a sort of billing rates. I kind of see it in that divergent where I don't have to, again, you're right. I don't have to take my IRS appraisal and try to go find funding for it and a buyer, to sell it.
I think it's important that the public that uses someone like you hear the cost associated with it, and they don't understand just how much time you're going to actually spend doing this work. It is way, way in depth to survive the scrutiny of regulatory oversight. And we get it all the time that someone will show up at our doorstep wanting a valuation for the IRS. And we always say, yeah, no, or divorce, no. I'll give you just one example. I got a call from the IRS and says, hey, Ed, I'm looking at your appraisal. I'm like, what do you mean? I'm just trying to follow what you did here. And I'm like, we didn't do that for that purpose. And this guy, he PDF'd it and edited the report and changed the purpose from sale to...
no.
Yep.
That's scary. That's something I need to do because I write it multiple places. This is just for this part of the, this gift return or something. But
well, I've started watermarking everything. If you're going to monkey with it, if it has this watermark, it's from me. That's my document. My point is that, look, don't go on the cheap. That's the way it works.
And what people need to realize is when you start reading the trial court, the IRS, when they go to court, if your appraisal goes to court and it gets litigated, one, that's very costly. Two, they pick apart every word, every assumption. So that's why our assumptions just have to be rock solid within the terms. We review a lot of case precedent to really make sure that if we're deviating from what the IRS has a stance on, we damn well know what we're talking about. And so, yeah, that's again, like we talked about, the trier fact and the scrutiny is for us most of the time is not a buyer-seller relationship. It's a big government. It's it's another attorney who maybe doesn't understand valuation, but knows how to put you into a pretzel sort of position. So you've got to know what you're doing.
All right. So every episode I ask this question, and it's the last one. And so if you were going to give a business owner advice, right, that is either going to make their business either more saleable or more valuable, what would it be?
I would say, going back to our theme of story, I would say your story needs to be consistent. And I'll give an example of that. I valued a gentleman who has a business. He came to me saying, look, I kind of want to just know what this thing might be worth, right? No plans to immediately sell, but he'd been working on it for 25 years and just has no idea where he's at. Hardworking guy. He's an electrical contractor, built an incredibly impressive process where he does all the stuff all the pre-work in-house. So when he shows up on a job site, he can be 5 times more efficient than any of his competitors. And he's like, oh, all of my contractors that I work with love me because I could show up and be done in like a day where other guys take 5 or longer. And that's an incredible story. That's an incredible competitive advantage. Then you go look at his receivable turnover, and he's like double the industry standard. And the issue is saying, look, yeah, you're doing everything right operationally with your business. You're getting the right clients. You have everything you could ask for in a business. Even though you're offering an exceptional opportunity for your client, which is the contractor of the job, the general contractor, they're still not paying you on time. And that was hitting. I mean, it was like every year is like $300,000 of cash that just wasn't coming in the door. That had a dramatic impact on the multiple right there. I mean, it's $300,000 times whatever multiple was. And it's like, you just immediately materialize value. So my argument is you want your financials to be consistent with the story that you're trying to tell. And if it's not consistent, then you can get hurt. If you can shore that up, your value is going to increase overnight.
Well, Charlie, one last thing is, how do people find you? How do they work with you? What's your ideal client? I know you work across the country, so let's talk a little bit about how people could track you down.
Yeah, certainly. My valuation firm is Stanton Valuation Advisors. It's stantonvalue.com. You can go to my website there. My email is charlie@stantonvalue.com. I generally work with, my referral sources are mainly attorneys and accountants. And so if you're an attorney or accountant listening and you work with business owners who need gift and estate tax work or litigation, divorce, shareholder disputes, you name it, we can assist with those. So, and I work with multiple industries, multiple business sizes, so can really handle a lot.
Right on. Well, Charlie, I sure appreciate finally getting to get you on the pod, and it's been a pleasure. You delivered as always.
Good to be here. Thanks a lot, Ed.
Thanks for listening to the Defenders of Business Value. If today's episode helped you think differently about building or selling a business, follow the show so you don't miss what's next. And if you want to become a more informed, confident owner, the one who knows how to grow, protect, and eventually exit at maximum value, subscribe to my newsletter. The link is in the show notes. And if you're ready to talk about your next deal, connect with me on LinkedIn. So until next time, we'll see you soon.